Why are the shorts under pressure? The answer is simple, and I'm going to show you this in a second. The silver is simply not there. The amount of registered, in other words deliverable, silver held in the CME warehouses is currently 88 million ounces. So I repeat that, only 88 million ounces are in CME warehouses. Sold silver that they don't actually have, they're short silver. The naked shorts are in the most precarious position. They must either find and buy silver before the end of March, or they must buy back their contracts. So if the scenario plays out as per the trend line, which looks likely, the naked shorts will have to be frantically buying back their contracts to reduce the open interest, which will be driving the silver price sharply higher. Hello, dear friends. My name is Clive Thompson. Today is Sunday, February 22nd, 2026. Today we're going to be talking about silver and the March contract and what's going to happen. In just 5 days, on Friday, February 27th, we will know whether COMEX silver, whether the shorts are going to be squeezed. For the silver bulls, it's looking like it's going to be an exciting day. The fuse is lit, silver is tightening, and if the shorts are overextended, this could get violent. I will keep you updated over the coming days as things unfold. If you don't want to miss anything, please like and subscribe and hit that little bell button to be notified when there's an update.
Clive Thompson opens with precision and urgency. The 5-day countdown to February 27th, the first notice day, is the organizing principle of the entire analysis. This is not a general silver bull thesis. This is a specific date-anchored event with mechanics that Clive is about to explain in granular detail. The word violent is deliberately chosen. In commodity markets, violent doesn't mean gradual. It means a price move that happens faster than most participants can respond.
First, a disclaimer. Please bear in mind that any forecast or prediction that I make is just that. It's my opinion as to what may transpire based on the numbers that I see today, and I'm going to show you those numbers. Those numbers may change, and my opinion may evolve in either direction. This is not investment advice, and nothing I say today should be investment advice. You need to take your own, look after yourself, get your own advice, or get an independent financial advisor to advise you who knows your situation. Now, what we're going to be talking about is the March silver contract on COMEX, and the question of whether there will be enough physical silver at the CME to meet that demand. But before we look at the silver shortage, let's quickly explain how COMEX works for both the longs and the shorts. The longs are the buyers. Longs are investors who've bought silver contracts for delivery in March 2026. Each contract represents 5,000 troy ounces of silver. So with silver at around $84 an ounce, each contract is worth roughly 420,000 US dollars. Now, longs can include speculators who think the price will rise and industrial users who need to take physical delivery. Shorts are the sellers. So the shorts have basically sold futures contracts for March, and they could be large bullion banks looking to take advantage of the contango. The contango is where the futures price trades at a higher price than today's spot price. So by selling the futures and then waiting till they get to today's date, they constantly make a profit and then roll back into another future and the future date. So contango is a way the bullion banks make money by simply constantly selling futures. They're constantly short, if you like.
This explanation of the contango trade is crucial for understanding why the shorts exist in the first place and why they are structurally large and well capitalized. Bullion banks shorting futures is not a speculative bet that silver goes down. It is a systematic harvesting of the contango premium. They sell the future, wait for it to converge with spot, pocket the difference, and roll. This has been a risk-free trade for decades because physical supply was always adequate to meet demand. The problem Clive is identifying is what happens when physical supply is no longer adequate. The trade that was risk-free becomes catastrophically risky.
Other sellers of the futures could be the refiners acting on behalf of the silver miners. Now I'm going to talk about margin. Neither the longs nor the shorts need to put up the full value of the contract. So today the full value of the contract would be about $420,000 per contract. They only have to post a tiny fraction of that value, which is called the margin. They post it as a good faith deposit. So both longs and shorts must put up margin. The margin is actually a very powerful tool for COMEX, for the CME, to reduce the risk of a delivery squeeze. So all they have to do to force out investors from the contract to reduce the open interest is to raise the margin. And the reason people will be forced out of the contract when they raise the margin is some just don't have the cash to put up the extra margin, so they sell their contract or close it. And some have better things to do with their cash, so they don't want to pay the margin, so they close their contract as well. So it doesn't matter whether you're a short or a long, you might have something better to do with your cash when they raise the margin on you, and you say, well, I'm out of here, I'll use my cash for something else. Or you might not have the cash, in which case you have to close your contract. So let's talk about how the margin has evolved over recent months. Back in October, the margin was $22,000 per contract. Then, in October, they raised it to $30,000 per contract. In January, they raised it not to a fixed amount, but to 9% of the contract value. That was on January the 13th. On January the 27th, they raised it to 11% of the contract value. Now, don't forget the value of silver was rising at the time, so that was more than a rise from 9% to 11% in money terms. It was quite a big rise. On January the 31st, they raised it from 11% to 15% of the total value of the contract. And on February the 6th, they raised it to 18% of the value of the contract. So the maintenance margin now, which is very roughly 18%, it's 17.5%, something like that, is $74,109 per contract, which is well over double, nearly triple what it was a few months ago. By tying up more cash, the CME is encouraging both longs and shorts to close their positions. Fewer open contracts means there's less of a delivery crunch coming in March. Now, who does the rise in the margin hurt the most? Is it the longs or the shorts? Well, in general, it helps, or rather it hurts, the longs more, those who bought the futures contracts. Here's why. When you are a short, your potential losses are theoretically unlimited. The price could keep rising to the moon. Because of this unlimited risk, shorts are typically large, well-capitalized institutions, bullion banks, mining companies, and so forth. Those the sort of people who could weather the higher margin requirements. They're not, in general, the man in the street who doesn't want to take on unlimited risk because he has much more limited resources than these big institutions. So in general, Joe Public is not short. He doesn't go short. I mean, there will be some, but not so much. Longs, by contrast, include many private speculators who are less well capitalized. Their maximum loss on a contract is just the value of the contract because silver can't go below zero. Well, in theory it might, but you may remember oil went briefly negative in 2020, which was due to the storage problems. I think the price of oil went to minus 30 or minus $32 a barrel. But yeah, silver shouldn't go negative. So the longs are more likely to be forced out when margin rises because they won't have the same sort of capital as the shorts have, who are well-capitalized bullion banks. They'll be less able to withstand a rise in margin. So by raising the margin, the CME is effectively squeezing out more longs. They're squeezing them out of the market, and that reduces the open interest, and that eases the pressure on the physical delivery system when it comes to maturity in March. So when the margins were last raised,
The margin hike timeline is the most important data series in the entire presentation, and almost nobody outside professional commodity trading is tracking it. From $22,000 to $74,190 per contract, a 237% increase in margin requirements in roughly 4 months is an extraordinary intervention. But here is the critical asymmetry Clive identifies. The CME designed this tool to squeeze out longs, not shorts. Shorts are the well-capitalized institutions. Longs are the retail speculators and industrial end users. If longs keep coming back to the market after each margin hike, which the 25% price recovery since February 6th strongly suggests, then the tool is failing to achieve its intended effect. The price rising 25% after the last margin hike tells you that demand from longs is overwhelming the margin pressure designed to eliminate them.
on February the 6th, silver was around $67 an ounce. It had come down a lot from the peak. Silver's now $84.63, up about 25% since that bottom on 6th of February. And it's up around 15% since the start of the year. Now that rise in the silver price tells us quite clearly that the shorts are feeling the most pain from the rise in silver. Now, why are the shorts under pressure? The answer is simple, and I'm going to show you this in a second. The silver is simply not there. The amount of registered, in other words, deliverable silver held in the CME warehouses is currently 88 million ounces. So I repeat that, only 88 million ounces are in CME warehouses. Yet the March open interest is the equivalent of 239 million ounces, nearly 3 times as much as the available supply. Now that number will change, and it will change downwards, but unless it goes below 80 million, there's going to be a problem, because that's all that's there at the moment, 88 million ounces. Now, nobody knows how many of those longs intend to close their position before the first delivery date. And that uncertainty is the shorts problem. And it might explain why the silver price has been rising recently. If too many longs stand for delivery, in other words, they do nothing, the shorts will be squeezed, and the silver price could explode upwards. Now, those shorts who hold enough silver are under no pressure. They can simply deliver, and we know there's 80 million of that silver in the registered category. So the first 80 million can be delivered. But those who are naked, and by naked I mean they've sold silver that they don't actually have, they're short silver, the naked shorts are in the most precarious position. They must either find and buy silver before the end of March, or they must buy back their contracts at whatever price the market demands.
The 3-to-1 ratio of open interest to available registered silver is the single most important number in this presentation. 3-to-1 is not a stress scenario. It is a mathematical impossibility that all contracts get delivered as is. The only question is how many longs close before first notice day. The shorts know this too. They cannot know how many longs will stand for delivery. That uncertainty is priced into the market right now through the rising silver price. Every day the silver price goes up is another day of losses for naked shorts who must eventually close or deliver metal they don't have.
So let's talk about the key dates which are coming up. The first key date is Thursday, 26th of February. This is known as the first position date. And this is the last day for the longs who do not wish to take physical delivery to close or roll over their March contracts. From this date onwards, clearing firms require that any remaining long positions are only held by parties with both the cash and the infrastructure to accept delivery. So basically, speculators and any fund which doesn't want the physical silver has to be out by that date. They must be out by that date, or they're going to have the cash ready to go at any point during the month of March. The next date is Friday the 27th, after the first position date. So Friday 27th is called the first notice day. That's this Friday coming in 5 days' time. This is the first day that a short can formally notify the exchange of their intention to deliver physical silver. So if a short notifies the exchange on that date, the exchange then assigns that notice to one of the longs. It can be any long. So if you're long on that date, you might get assigned, you might not get assigned, but a lot of the shorts will give the notice on that date for assigning their silver if they've got it. So it's the short, not the long, who initiates the delivery. The long can't say, I'd like delivery tomorrow or next week or next month. The long can't say anything. It's the short who decides when to issue the notice, and as soon as the notice is issued, the next day, the silver is going to be delivered. So any long who is still open on February the 27th, the first notice day, or rather, if he's long the day before, the previous day, the 26th, and hasn't closed his position, he will simply receive whatever notice the exchange assigns to him, and he have no say in the timing. And once the long receives the delivery notice, he can't exit. He has to take and pay for the physical metal. That's why any long who does not want the metal must be out of the market before this date. And therefore, by implication, any long who does want the metal will still be in the market on that date. And we can judge how many longs are involved there by looking at how much the open interest is on that date. So that's a date to watch very carefully. The next date which comes up is Monday, March 2nd, known as the first delivery day. That's a week on Monday. This is the earliest date on which the actual physical transfer of silver can be completed. So what happens? The short delivers a vault warrant representing silver held in a CME approved depository to the long, and the long pays the full invoice amount, i.e. 5,000 ounces multiplied by the settlement price, to the short. Now, delivery can happen on any business day from the first notice day, or the first delivery day actually, which is the day after the notice day, through to the last delivery day. The last delivery day is the 31st of March, but the delivery will always take place the day after the notice has been given. So really, the day that the silver is going to be delivered, it will be dependent on which day the short decides to give notice. So the first delivery day, 27th, this Friday, is simply the earliest possible date that the first delivery date's the March the 2nd, is the earliest possible date the metal can change hands. After that, we're expecting all the people who are long to take delivery, unless the price rises sufficiently to encourage them to close their contract and take the profit. So from the first notice day onwards, the shorts control whether a notice is issued for delivery, and therefore they control on what date the silver will be delivered. So any long who's open from the 27th onwards, 27th of February, is at the mercy of the shorts' timing decision. But of course, they will have the money available to pay for the silver, and they will be wanting to take delivery of that silver. They just don't know which day it's coming.
The delivery mechanics Clive explains here are almost entirely unknown to retail silver investors. Most people who own silver ETFs or paper silver have never encountered the concept of a first position date or a first notice day. The critical asymmetry, the short controls when delivery happens, the long simply waits, is what creates the pressure dynamic. If you are a naked short and you don't have silver, you know that every long still open after February 26th specifically wants physical metal. You are now racing against a deadline with an unknown but rising number of counterparties who want something you don't have. February 27th is the day the fog clears. We will know exactly how many longs are standing for delivery. That number is what moves the market.
However, given that there's a shortage of registered silver compared with the number of open contracts at the moment, don't forget there's nearly 3 times as many open contracts as there is silver available, it's the naked shorts, those who've got no physical silver, who are in the most precarious position. If a significant number of the March contracts remain open after the first delivery day, the 2nd of March, we could see an explosive upwards movement in the silver price during March. Now let's look at the silver inventory and see how much is there. And we'll look at this chart here, which is coming up. What we're looking at here is the number of registered deliverable silver ounces held in CME warehouses. And the chart goes all the way back to October, when there was around 170 million ounces of silver in CME warehouses. 170 million, and today it's around, Today it's around 88 million. So it's gone down from 170 million to around 88 million. So the trend is stark. The number of ounces held in CME warehouses has been cut in half in a few months. Now the dashed orange line that you see is a trend line showing how the trend will be if it continues. And looking at this dashed orange line, it suggests that we could be down to 80 million from 88 today by the March the 2nd. So on the first delivery day, there might only be 80 million ounces at the CME. Now, at the same time, I'd like to refer you to this vertical green line. This vertical green line tells you how many ounces of silver were called for delivery a year ago in March 2025. And the answer is it was slightly more than 80 million. So in theory, literally all of the silver in COMEX, in the CME, might be delivered to new owners on or around the 2nd of March. Now, does that mean that the number of ounces in the registered category will go to 0 on that day? No, it doesn't mean that, because what happens is when the warrant is delivered, the silver stays where it is, it's only the owner of that silver who changes. So that silver is still there, still available for delivery as registered silver, but it's now just got to a new owner. But of course, the new owner might want it or need it, and they could, and they might well take it out because they need it for their production, or they're an ETF and they need to store it somewhere else. So although you might think, when you look at this chart, that the number of open contracts could get down to 80 million and they all get delivered, you might think that the ounces of silver in COMEX in the CME go to zero. That's not the case, because the silver still stays there. It's just the owner which is changing. But then it will get withdrawn. So some of the users will take delivery: automotive companies, solar panel companies, electronics companies, defense manufacturers, and so forth. They will physically remove the silver from the CME over time. Now, if that withdrawal continues, the downward pressure on the registered inventory will continue to intensify. And don't forget, we've got the deliveries in April and May coming up. Now, April's not a big month, so we won't worry about that too much, but May is usually a very big month. A year ago in May 2025, the deliveries reached 75 million ounces. And there's good reasons to think that this March will be at least as high as it was a year ago, of 80 million ounces. In fact, it could be much higher.
The halving of CME silver inventory from 170 million to 88 million ounces since October is the structural supply crisis underlying everything Clive is describing. This is not a temporary fluctuation. It is a sustained directional drain that has been occurring week after week, month after month. The implications for May delivery are potentially more significant than March. March could create a squeeze, but if March delivers the majority of registered inventory to new owners who then remove it for manufacturing, what happens when May contracts come due with potentially even less registered silver available? The cascade effect is what makes the silver market setup in 2026 qualitatively different from any prior squeeze attempt.
So, given that there won't be more than 80 million ounces, by the looks of things, in the CME on the first delivery date, the 2nd of March 2026, what's going to happen by the time we get to May? There's the big question. So let's have a look at the situation now. I'm going to look at the with the open interest. I'm looking at the same chart now. That's coming up. There we are. This is the same chart as before, with the registered deliverable silver held in the CME warehouses, but I've expanded the scale to include this green line going down, which shows the open interest for March silver. Now you can see the lines falling. That's perfectly normal. There are currently 47,847 March contracts open, which represent 239 million ounces of silver. That's nearly 3 times the registered inventory of around 88 million, or what will by that date probably be 80 million. Now, open interest always falls sharply as the first notice date approaches. That's completely normal. The interest, or the question we've got, is how far it will fall. Based on the current trend, which is the pink dashed line here, around 125 million ounces could still be outstanding for delivery on the first delivery date, March the 2nd, which would be significantly more than the projected 80 million, which might be held at that date, and significantly more than the 80 million which were actually delivered in March 2025. So if the scenario plays out as per the trend line, which looks likely, the naked shorts will have to be frantically buying back their contracts to reduce the open interest, which will be driving the silver price sharply higher. So the worst case for the shorts, and this is an unlikely event, but I'm going to tell you what it will be. In the unlikely event that the open interest barely falls, the shorts would face a catastrophic squeeze. They would need to source silver far beyond what's available, or more likely, they'd have to keep bidding up the price until the longs are willing to sell. Either way, it looks like the silver price moves explosively higher. So let's see what's been happening to silver. Here's the chart of silver. Silver closed on Friday at $84.63. Now that's well below the peak here at the end of January. That was a peak of $121.67 right at the end of January. But it's also significantly above the low, which was $64.08. And that low occurred on 6th of February, the last time the margin was increased. So silver has risen about 25% from the low point to this $84.63.
The 125 million versus 80 million comparison is the mathematical heart of the squeeze thesis. If trend lines hold, demand for delivery on March 2nd will be 56% higher than the available registered silver. There are only three ways this resolves. Longs close voluntarily and take profits. Requires price to rise enough to motivate them. Naked shorts find and source physical silver from outside the system, extremely difficult in current shortage conditions. Or naked shorts buy back contracts at rising prices, the squeeze. Clive is careful to distinguish between the trendline scenario and the catastrophic worst case. The former is likely, the latter is unlikely. But even the likely scenario involves explosively higher silver prices, as 125 million ounces of demand chases 80 million ounces of supply.
And that it's risen 25% in maximum about 11 days. Yeah, 11 days, less than 2 weeks. So this rise in price is telling me, and it's a strong signal, that the shorts are under pressure to close their positions because they're not sure they're going to be able to lay their hands on silver to deliver at the end of March or on or before the end of March. Of course, many of the shorts will have silver and they'll just be delivering it and getting the cash, and they're the ones who are likely to deliver on the earliest date, the day 1, the 2nd of March. But those who haven't got the silver will be hoping that the price goes down, or thinking that they can get it from some other source, perhaps by an inwards delivery from a miner or somewhere or a smelter. So what do we need to watch? What's going to happen? Well, there's many moving parts, and a great deal could change in the next 5 days. The amount of registered silver might go up or down. The trend is down at the moment. The level of demand for delivery might be higher or lower than last year. Currently, it's looking like it'll be higher. The CME could raise margins again, forcing people out of the market. They've raised it multiple times in the last few months. It's entirely possible they might decide to raise margins during the course of this coming week. We simply don't know. What we do know is this. The numbers we can see today are pointing to a potential shortage. Registered silver, the registered inventory, is at a historically low level relative to the open interest. And the trend in open interest suggests that more longs will be standing firm than in recent years. And the price action of silver itself rising, general upwards trend, tells us that some shorts are feeling the pain and starting to close their silver as a precautionary measure. So what can we watch in the coming days to see what's going to happen and get a view how fast silver will rise or potentially not rise and go backwards even? Well, we need to keep an eye on, let's go back to this chart. We need to keep an eye on this March open interest. Does it follow the trend line, in which case there's definitely a problem, or does it start to accelerate, in which case there's less of a problem. We also need to look at the registered silver, which is the silver inventory at CME. Does it continue to fall as it's been falling week after week, month after month for a long, long time? Or does it turn around on a sixpence and the registered silver inventory starts to rise as people deliver in? For example, smelters delivering in, silver miners delivering in, or conversions from eligible to registered. Another thing to watch is the margins. Does CME or will CME raise the margins again? If they do, you can bet your bottom dollar they're doing it because there's a potential crisis looming, and that's even though it might be negative for silver on the day they do it, because it'll force some longs out and some shorts out, if they do it, it's kind of signaling that they're trying to stop the price of silver moving up too fast.
Clive's three-signal framework is the practical tool viewers need to monitor the situation in real time. The margin signal is the most counterintuitive and therefore the most valuable. A CME margin hike, which typically causes silver to drop on the day, is actually the most bullish long-term signal possible. It means the CME itself sees a delivery crisis forming and is desperately trying to prevent it. The inventory signal requires watching daily CME warehouse reports. The open interest signal will become definitive on February 27th, when first notice day reveals exactly how many longs are standing firm. Between now and Friday, every tick in these three data series is a real-time indicator of squeeze intensity.